Hey everyone, this episode is brought to you by Avalanche. Everyone's favorite red coin is a fan of On the Margin, and we are a fan of Avalanche as well. Talked about it on the program before. Avalanche is a very cool solution. Their subnets allow for a very scalable blockchain that's also interoperable at the same time. And it's not just me. The institutions are noticing and they're building on the evergreen subnets as well. You're going to be hearing all about some of those institutions later in the episode. For now, Avalanche, thanks for making this possible. Hey everyone, this episode is brought to you by Mantra, the security first, compliance focused L1, which is onboarding the next wave of financial institutions. You're going to be hearing all about them later in the show, but for now, Mantra, thanks for making this episode possible. Hey everyone, this episode is brought to you by Kinto, the safety first L2, accelerating the transition to an on chain financial system. You're going to be hearing all about them later in the episode, but for now, on with the program. All right, everyone, welcome back to another roundup of On the Margin. You got Felix, Tyler, Quinn, fellas, welcome. How are we doing this week?
Good day.
Pretty
Fantastic.
Doing great. Sun's out. There's bears in my backyard. I don't know if anybody saw the tweet video I put out the other day, but they're out and about and grazing. That's what happens when you live in the mountains of Canada.
The most Canadian thing ever.
That's pretty sick, not gonna lie. I wish I had bears.
Yeah, you don't get much of that in New York.
The bear sighting plus Felix's favorite macro contra turning bullish is scary.
Yeah, who is that, Felix?
For the sake of our show, I will not be naming names, but yes.
There will be a big reveal at the end of the season.
Yeah, you got to stick around for that one. But there'll be a hint of it when we get back into the meme of the week.
We got a little light roast, I think, by Andy Constant. On Andy's great, by the way. He's been very good, especially on all things QRA. He's been pretty dead on.
Yeah, I love Andy. I'm happy to take some criticism from him. It's at least well-founded. That's all I can ask for. Let's get into it. But this morning I think we had a dual print that has sent markets moving in some pretty sizable directions. The first half of it was the University of Michigan survey of inflation expectations and consumer sentiment. And I just came across this chart that I thought was quite shocking. It's just the actual versus expected of it. That was, basically a huge miss. It was basically a 7 sigma miss on the sentiment aspect of it, which, one of the main reasons that they had mentioned for the reason why it was so low is this two-tailed issue of, stickier inflation, and with that, higher interest rates that are starting to squeeze discretionary spending and income. And for me, one of the first things that I thought about is just tying back to what we were talking about last week around Coinbase earnings. And what we saw is that retail is definitely not back in crypto right now. And we're seeing it a lot in just how PvP, the market structure is still these days. And for me, when I look at this, it starts to add up somewhat. And, Mike, we were talking off camera that you sort of had a different take on this, that tying these two together, that a really depressed consumer isn't willing to spend and gamble on cryptographic assets. You don't think those are tied together. You think the other.
Yeah, I don't think that's actually. Here would be my pushback. And this is actually something that Tyler told me a number of years ago and gave me a framework for this. You probably don't remember, Tyler, but you're describing these situations where, especially in an inflationary or stagflationary environment, one of the adverse consequences of that particular regime is that people see that the payoff on doing things like gambling and speculating is actually higher than productive work. And ever since you said that, you said that basically right before we went into a bull market in crypto, and those little pearls of wisdom that you dropped on me got reinforced tenfold, because I lived through this insane cycle, and it's extremely difficult to company build in one of these crazy inflationary boom environments where it just feels like people are making money left, right, and center. And there's differing data points about what people can afford and whether people have more money or less money than they did. I will say wages have kept up decently well with inflation for the most part, but I actually think when you get into these weird inflationary environments, it leads to people gambling more, not less. And the other thing that I think is a really just sad fact about human nature is that when people are put in more desperate circumstances, and when there isn't a path towards achieving something that feels like financial freedom by doing things, quote, the right way or on the understood path, it pushes people more towards gambling and not less. And the data point that I would give you is the blowout numbers that these US based gambling companies are putting up year over year. So, I don't think that people are unable to rustle up a couple $100 to chuck into meme coins or whatever, shit coin they want to invest in, but they can find billions of dollars to punt on, sports games. I think it's something different.
To your point, DraftKings is from the beginning of 2023. It was at $10. It's now at $40, 4x.
There is also a bit of red tape arbitrage around that, though, because I think a lot of policies changed over the last few years for sports betting and gambling, where they couldn't advertise before and weren't even really legal in a lot of states, and now it is. So I'm sure it's a bit of both as well.
I will just say Americans, the exact stat is Americans gambled a record 66.5 billion last year. So this was all when inflation was going on. And yeah, I don't think the link is quite as clean as people don't have money and they aren't willing to gamble. And actually the other statistic, again, these are all just sad statistics to give you. As soon as you get into the world of gambling, it's all sad statistics, but it's the poor people that buy the lottery tickets,
Are you guys big believers in the financial nihilism thesis and all of that people have been talking about?
I think there's a component to it. I mean, if you're staring down the barrel of massive amounts of student loans and the asset values are without, I was talking to a undergrad at BC. Boston College is now $90,000 a year, and which is just insanity.
That's nuts.
Doubled since I went there.
Plus your real estate in Boston and cost of living in Boston.
Yeah. So you're looking at, a mortgage payment when you get out just for student loans. And I probably would feel so burdened coming out of school with like a normal wage and that type of debt. And then you add in like housing costs rising. And I could get to a place of financial nihilism where you're like, who cares? They're going to forgive my student loans anyway. Might as well bet like any extra cash on some crazy stuff.
It's the only time in the world where you can get the type of leverage that they offer, because in what world could you go get a mortgage for, okay, let's say Boston College is all in, you're probably, if you don't have any support, raking in $500K in debt or something, if you're talking $100K a year or $400K, and you're coming out with like a $60K starting salary. Yeah. I mean, the leverage on that is bananas, but it's only student debt where they allow that. But you couldn't do that for any other job if you have that sort of income and leverage.
They gladly hand it to you.
Yeah.
It is kind of insane, but I think that's, to one of our points. I don't know if you guys want to move on to the student loan debt jubilee.
Maybe we should. Yeah.
But one of the charts I found was the student loan interest rate expenses are expected to rise to 6.5% in July, up from 5.5% currently. So not only do you have trillions of dollars of debt and student loans, I think maybe it's 1 point some trillion, and the interest rates are rising because they're piggybacked off, probably the 10-year. I don't know exactly, but this is a major problem for Biden, and it's why they're seeing student loan forgiveness. This is just going to keep happening more and more, in my opinion. Is they're looking down the barrel of a fiscal debt spiral and U.S. student loan spiral. The next generation just feels completely annihilated. That Scott Galloway YouTube of basically, I think that's nailing the vibe. And people are starting to kind of pipe up and say, you got to do something about all this stuff.
It's pretty crazy to see this actually start to occur. Like we read these old, monetary history books, and they talk about debt jubilees. They talk about it happening even, during the Roman Empire. And you're like, how could we just collectively as a society decide to just forgive a bunch of debt and be like, all right, let's pop some bottles of wine and just, start from scratch again. Like, to me, when I read those parts, I'm like, how is that even conceivable as a society? But, it's a game of just small steps, I guess, because we're seeing this. We saw, what Bernie Sanders and that side of the party had introduced some legislation this past week about forgiving all medical debt. Yeah, it's just in little steps, I guess.
Yeah, it's little steps. You know what else they did? They're floating into the election is this, Fannie Mae or Freddie Mac home equity line tapping, which is about $4 trillion of potential equity in homes that people can lever up and take money against. So you want to lower, your home equity line rate so you can essentially put lighter fluid on the economy from people who have equity in their houses, which makes sense. I mean, like this is the the volatility controlling, like they're pulling out all the stops to kind of keep this thing paper over all the things that are problems. It's like whack-a-mole, boom, boom, boom. And that's what we keep seeing as soon as you get to these extremes.
I think that's what's plaguing the market right now is this like stop start of liquidity. It's not the clear one direction, one dimensional situation of Q4 where the market was offsides to the downside. Liquidity was coming back in a big way and inflation was still coming down so they could unleash. Seems to be we're more in this, I think of it like a stop start environment where problems occur, yields rise, dollar rises. They need to talk it down. And that's where we'll see going into the election. Like if they could, they would unleash all these stimulus packages, but that requires financing. So it'll be interesting to see how that plays out.
So on the point of the student loan stuff, I'm a little bit of two minds about this because if I was going to be a one issue voter, it would be something around the idea of education. It just feels really intuitive to me that if you want to improve things, you got to rewire the software that's going through the hardware of people, right? Like that's the only way to really achieve better outcomes. And the way that we do student loans and offering debt to extremely young people at very high onerous rates, it just feels broken to me. That just feels like a broken system. So on the one hand, I really understand this is just a government handout, right? Which people have been doing since the dawn of time to win elections and get people on their side and stuff like that. It's just a handout, right? It's a really nice rebrand of like loan forgiveness from handouts, but it is a handout. But also, man, if you talk to some young people who, if you came from a family that didn't have means, it wasn't like, oh, you didn't really think that much about going to college. You're like, yeah, I need to go to college to get a job. And then you can wind up with $150,000 in debt and just feel like you're never going to get out of it. By the way, the interest rates, I saw 6.5% on there. Like some of these private loans can be as high as like 12, 14%.
Yeah.
And these were being issued at a time when Fed funds was at like 3%.
Yeah.
So
it's ludicrous.
It's nuts.
Are most student loans in the US given out privately?
I don't know the breakdown, but I know the government does some, and then you layer on some private loans on top of it. But here's the thing: is like, if I was someone who paid off my student loans, and
you'd be pissed.
I was so ludicrously pissed. That's the second time I've used the word ludicrous. But like, I would be absolutely livid, and you're incentivized not to play by the rules at this point, which is breakdown of the social contract.
I think that's what it's these little cuts in both directions. Like, and you're seeing that with, I feel that the acceptance of being a Trump supporter is greater than any of the previous two elections, because I think over time, these little cuts add up where it's like, you get enough of these misallocation of capital stemming from government policy that, turns people against those decisions and it eventually backfires. The populism thing, like you can only go so far in one direction.
It's really interesting, right now, to that point about people being outraged and, somewhat rightfully so. But a lot of the discussion right now as well is around, are these, student loan forgiveness plans being funded by my own, tax revenues, or is it being printed? And right now, a lot of the sentiment is outrage because people feel like their taxes are going directly towards this. But if we keep moving down this path where more and more it's done through debt issuance and basically money printing, I wonder if that changes the calculus. Because, just tying back to that clip we watched last week from Stephanie Kelton's new documentary, where, a lot of what she's trying to do is basically go on this campaign to figure out, why are we issuing debt and why don't we just print all this money? And she was really trying to prove that out. And I think we're getting to somewhere there where it anchors, skin in the game and moral hazard to actual like capital allocation. Because if we just print money and then just hand it out in these different means, there's no real responsibility, versus if you're doing it through, basically tax revenue, have something that you can anchor it towards. It keeps those moral hazards in check more so, I feel like. So if we go down this path towards printing, I feel like it takes away a lot of those responsible, anchoring.
Hey everyone, this episode is brought to you by Avalanche. Avalanche is a leading network of blockchain which is giving access to some of the world's largest financial institutions to experiment and build on crypto rails. I'm a big fan of Avalanche. I've talked about it on this program before. The subnet architecture leverages some of the best parts of IBC over in Cosmos, the interoperability protocol, and the rollups on Ethereum, with the result that if you're a financial institution, you can build on something that's highly interoperable, but also customizable and scalable. And it's not just me. Many of the largest institutions in the world are taking notice. And a couple examples of folks who are building on Evergreen subnets include Onyx by JP Morgan's. They leveraged an Evergreen subnet to explore how tokenization can revolutionize the asset and wealth management industry. Citi and the DTCC digital assets are testing private market tokenization on the Avalanche Spruce testnet with Wellington and Wisdom Tree. So again, some of the largest financial institutions in the entire world are building on Avalanche. Avalanche Evergreen provides a suite of institutional blockchain deployments, customizations, and tooling designed to address company-specific and industry-wide requirements for financial services. So join the institutional investors that are choosing Avalanche today. Go to avax.network/evergreen. Again, that's avax.network/evergreen and join the revolution. Avalanche, thanks very much for making this episode possible. Hey everyone, this episode is brought to you by Mantra, the security-first, compliance-focused L1, which is onboarding the next wave of financial institutions into Web3. So you guys have heard me talk about Larry Fink talking about tokenization. You've seen the clips on CNBC. You know that Larry and BlackRock are very, very excited about this idea. And the reason for that is they're looking at these trillions of dollars of off-chain real-world assets. They want to digitize those and bring them on-chain, which is going to be a massive opportunity. But in order to do that, they need a compliant L1, and that's where Mantra comes in. Mantra's been steadily climbing the ranks and now stands among the top 4 RWA projects on CoinGecko, which is representative of its rapid growth and influence in the tokenization space. Mantra's built using the Cosmos SDK, so they have some very cool stuff out of the box. They've got IBC interoperability. They also leverage CosmWasm smart contracts. Very cool design from an architectural standpoint. The next phase on the blockchain's testnet is Hongbai, so that's launching soon. So if you're a dApp developer or something like that, there's a lot of very cool opportunities for you. And I highly recommend that you click the link at the bottom of the show notes. That'll know that I sent you. Thanks very much again, Mantra, for making this possible. And again, guys, click the link at the bottom of the show notes. This episode is brought to you by Kinto, the safety-first layer 2 that is accelerating the transition to the on-chain financial system. Now, I know we're all very excited about tokenization. Larry Fink certainly is. He's on CNBC talking about it all the time. And I know we're all very excited about L2s. Here's the problem, though. If we want L2s to onboard the financial system, there's a lot of stuff that we still need, and Kinto is basically rolling out solutions for that. So one, it features user-owned KYC, which is just table stakes for our regulated friends, and if we want the institutional capital to come in, Kinto offers a really good solution for that. They also have native account abstraction that solves some of the largest problems with onboarding in terms of security and user experience today, which is still very confusing. So if we want to bring more folks onto Ethereum, Kinto is the way to do that. And if you believe in this on-chain financial system and you actually want to get more active in Kinto and become a founding member, you should join their launch program, which is Engine. That's ENGN. You can see a link in the show notes. So if you're a part of that, you can do things like participate in Kinto governance, the launch ceremony, you can priority access to product launches on Kinto, you get reduced fees and unique discounts on products launched on Kinto. So overall, if you want to be a part of Kinto and the mission that they have, I would go click the link, join the Engine program, and thank me later.
Yeah, you need to make the institutions in charge of like some of the debt forgiveness. There's no like, if you're charging 14% higher tuition every year and wages are going up 3 to 5%, it's like you're the problem. These levered hedge fund higher education institutions are the problem. Like that, they're hedge funds. They're not institutions.
So Felix, is the point so I think you're getting at a really interesting point, which is what we're doing with money printing and just issuing debt to fund everything. It obfuscates the need to make a trade-off, right? Yeah, of course, we'd like to just print a bunch of money and give it to everyone and forgive everyone's debts and let people go on vacation twice a year. But there is a real cost to that, which is everyone getting essentially diluted, their cash hoard getting diluted, right? I do wonder if this is a money problem or a technology problem or just a human nature problem in general, because this exact situation that you're describing has existed across tons of different societies and different monetary standards. And like you can go back to all of these, like the Colosseum in Rome and the Circus Maximus and all this shit. That was just politicians bribing people for elections. Like the reason we have all these cool monuments was people just bribing everyone for elections. And you go back, you're like, why are they building all these temples? That's what people wanted back in the day. They were like, that is a dope temple to Athena. She is gonna protect us. Thank you, Augustus, for creating this dope temple. It's the same thing. And they had a totally different money. They had gold back then. This stuff happens no matter what, because governments, this is their incentive, right? To pay for things and then obfuscate how they pay for it and have someone else do it.
I like the word choice there. That's what I've been kind of using a lot as trade-offs here. And the US has had this exorbitant privilege of not really having a trade-off, because we've been able to run 7% wartime, recession time fiscal deficits without issues. If 75% of the world tried doing that didn't have our economy or our world reserve currency status, it would have been game over for their monetary and fiscal situations a long time ago. So I think that's what, and we're not there yet. The RRP is still at a couple hundred billion, TGA is at almost $1 trillion. So that trade-off, I think, still is a ways out, but probably happens next year, where, right now you can just say free money for everybody, forgive debt here, forgive debt there. But there's going to be a trade-off at some point when these, excess reserve facilities run out and you have to finance directly in the market. And that's what I think is the crucial point, that's going to be coming, but probably still a ways off.
I gotta say, it's incredible how well we can keep kicking cans down the road. I don't know if you guys saw Stan Druckenmiller's interview this week on CNBC, but he had talked. He kind of went on a rampage about just the whole complex of forward guidance, and we're talking about actual forward guidance, not Jack Farley's podcast, but just what the Fed has been doing over the past decade or so. And this idea, he basically was just saying, we need to get rid of forward guidance, and if we're going to cut, and if we're going to hike, but it's doing a lot more harm than good. And in his words, he's saying, Jerome Powell, you're not a rock star. Don't get on 60 Minutes and talk about all these things. Just get the job done. And I think that really just shows where we're at right now, where their most powerful tool is forward guidance. Like, as we see, Fed funds rate is over 5%, and the economy is still doing great. And a lot of the reason is because the economy is so loose when you look at it through the lens of the long end bond yields of 10 years and higher. That's just allowing the economy to keep going. So their biggest tool these days is job owning and forward guidance, but that can also get them in a lot of trouble too. You saw they basically put themselves in a corner a couple of years ago where they couldn't hike rates because they had to taper QE before they can even do that because of forward guidance. And that was probably a huge issue for why it took them so long to actually get inflation under control.
I think the reason for that forward guidance remaining put is, it's like when someone starts going down the road of telling a lie, and then the lie snowballs, and then you don't even know what's the truth and what's not. When you get in such a sticky situation and you can't just explicitly say what's going on, you have to obfuscate it as much as possible, and the forward guidance helps them do that by adding this dimension. Because if you're the market right now, you're like, okay, I'm reading the data as it comes in, and we're gonna, as a market, like is done with Fed fund futures pricing and interest rates and commodities, we're going to assess and price in what we think the probability of forward rate expectations are, and it's market driven. But then you have this Fed forward guidance job owning that adds this other dimension of, well, the data shows this, so price it in here, but the Fed's over here, and you have to just obfuscate it because the truth is pretty bleak in reality in terms of the fiscal deficit spending problem. So I think that's what it is, and ultimately it probably does get removed down the line, but only after the Fed loses credibility a couple times, like we've seen from this December pivot.
Yeah, you know what I'll say though, and this is probably a good segue, but look at the credit market. It is fine. So it's working. So this is high yield bonds trading sub 250 basis points and 350 basis points, which the spreads of high yield bonds, the lower they go, the more people are willing to pay up for high yield bonds. It's almost at 2007 levels. So like in this past week, you had like a record weekly issuance in the high yield market, and it was gobbled up by bond investors. So whatever the Fed's doing for guidance is actually keeping the corporate bond market very healthy. all the problems, and I think if you go one more slide. So this is the other interesting thing. So this is from Piper's derivatives guys, who I think are the best on the street. They said long dated TLT vols are back near lows. So it's a 14 implied vol on this. TLT is the 20-year Treasury ETF. So people are betting on this bond market implosion. It's just not happening. And the bottom is the TLT skew. So what you pay for puts relative to calls. People are betting on TLT going down. So yields rising on the derivative side. So essentially people are way too bearish for where the volatility is in the bond market. And my point is the forward guidance seems to be working for the bond market right here, even though it's almost like a Wile E. Coyote where they're going off the cliff and they say, hey, we're fine. And then like you'll have these moments where you look down and you're like, oh shit, yeah, we have a 7% deficit and, you know, inflation's getting worse. So that'll come eventually. But right now, I think people are positioned wrong in the near term.
I think the answer to this is the nominal versus real, because if you look at HYG divided by gold, for example, it's down only because in real terms. So while credit in nominal terms is very strong, that's simply because we're spending these deficits in nominal terms, but you're as a credit investor, you're doing horribly in real terms because you're losing all this purchasing power, is kind of how I view that. Because one, the last time we had a recession, 2020, the Fed started buying high yield bonds, which is Japan move.
I was gonna ask about this.
Yeah.
Because like I feel like we forgot about that fact that they started to buy actual corporate credit, which is crazy to me. And I'm wondering if, because they open up that can of worms, have corporate spreads secularly closed, like even at like a cycle high, the credit spreads, are they narrower now because there's that tail probability that the Fed might buy credit again?
It has to be to some extent, for sure.
You also have an aging demographic and like all these life insurance companies. There's so many like mandated things that just have to buy yield. And so they'll take a negative real yield against inflation because they're old people and they don't want to lose money.
That was an insane day, by the way. I was still at Guggenheim at the time on fixed income the credit. That was insane. Like no, the markets were frozen. No one could issue for 2 weeks, and these companies it was just all a big restructuring. Like the credit markets were completely done. And
do you think it's a good thing that they jumped in and actually signaled that they're willing to buy corporate credit? Because I know some people believe that was illegal, and they had to basically start like their own special purpose vehicle to actually even do it.
Yeah,
because it might go against the Federal Reserve Act.
Yeah, they gave it to BlackRock, didn't they?
Yeah. Threw it to Larry, go buy some Apple AAAs.
We should laugh at that. It's like kind of messed up.
It was pretty wild. Like that was my first seeing something like that behind the scenes. We had issuers I worked with on a lot of oil and gas companies, and these guys, oil was zero, and these guys were toast. Like these companies were talking directly to the Fed for financing because there's the primary and secondary facility that the Fed opened up. And so the Fed was issuing credit directly to these triple B companies, basically. Like that, like a lot of
with
the big
oil at $0.
Yeah, I mean it was a pretty crazy. I mean they probably had to do it.
Yeah,
and then you get into more. It becomes more of a political debate whether or not everything should have shut down and all that. I think, like, given the fact everything shut down.
What's interesting is like, yeah, they had to bail that out, and now instead they're just annihilating the middle class. That's the easiest ones to annihilate. They don't, it takes a while for them to really wake up.
I think the less controversial thing is that what they didn't have to do was keep stimming through late 21, right? Like, okay, if we recovered, we got out of this gap, everything's opened up. You probably don't need to be handing out $1,500 helicopter checks a year and a half after, and they didn't start balance sheet reduction until March 22. So I think that's where you should probably point the beef versus like the immediate response.
Hello, listeners of On the Margin. I've got good news for those of you who are in the crypto scene. Blockworks is bringing back permissionless. We're going to be doing permissionless 3, and this year we are heading west. So we're moving that out to Salt Lake City. That's going to be October 9th through 11th this year. We've got a phenomenal lineup of speakers for you. So we've got Balaji headlining. We've got Sriram, Munib, Matt Hogan of Bitwise, Jan Van Eck. This one's going to be a blast, guys. And I saw many of you out in London for a DAS this year, and I hope to see you out in Salt Lake for Permissionless. And because y'all are such faithful listeners, we've got, if you use code MARGIN10, you're going to get 10% off your tickets. Appreciate you all. Hope to see you out there. I've got a question for you guys about forward guidance. So forward guidance is, so totally understand how it's become bastardized from the original intention. And depending on, I know in that Stanley Druckenmiller interview, he credited Ben Bernanke with that, but I think that goes all the way back to, I mean, I always had thought of Alan Greenspan as the original architect of forward guidance and the first guy to use that really effectively as a tool to impact markets. And one way that you could look at that is, maybe the most cynical viewpoint would be that this is just the Fed trying to control the market or influence something based on how they want the economy to go. The other thing would be is to say that it's actually a step forward in terms of transparency. And I think pretty objectively, you could say that the Fed has gotten more transparent. And the IMF does these rankings of different central banks in terms of their transparency. And I know we all call the Fed super opaque and a black box, and everyone scrutinizes every wrinkle on Jerome Powell's forehead. But at least, they actually do minutes. And the guy gets up there and explicitly explains his viewpoint and takes questions from reporters. Here's something I've been thinking about in crypto for a long time is you have economic systems and currencies like Bitcoin or Ethereum, and there is governance there, but I don't know how it works. Like people are talking about changing Ethereum's issuance policy right now. What's the framework? Like, who gets to decide that? Like, are there questions that I know there's some sort of vague process around, there's the idea that they're not going to do it if the community doesn't want it, but who is the community? Where is that spelled out? I don't know. I actually think that, if you were to eliminate forward guidance, it would have a negative impact on transparency, at least. And I actually think that maybe this is a really controversial thing to say, but in a lot of ways, the Fed is frankly more transparent than a lot of these crypto systems that claim to be super transparent. At least I understand.
So what you're saying is you're smarter than Stan Druckenmiller.
I am not saying that. I am absolutely not saying that. No. But isn't that the flip side of that? If we didn't have forward guidance, what's the policy around transparent? Like, how do we, is whatever warped version of the truth that we're getting now worse than just a pure black box?
I think the other side of that coin is that these people that are making these decisions at the Federal Reserve are not democratically voted in, but are rather appointed. And I think a lot of those, they've adopted a lot of those aspects that should probably reside within people that are voted in versus appointed in. And I feel like the Fed should focus more on some of these more specific aspects, like if you're going to hike, and if you're going to cut. But a lot of this big picture thinking, I feel like, has been taken over by those that are appointed rather voted. So if they're voted in, I feel like I would agree more.
You know what gets me a little angry is every Canadian I know knows about the U.S. system better than most Americans I know.
Yeah. My college roommate is an English guy. He knows more about our system and like our history of presidents than I do. And just pathetic.
It is.
Yeah. Pathetic.
I mean, it's tough. I don't even look at Canadian markets. Like, everything for me is on the U.S. And because, I mean, our Bank of Canada is just going to copy the Federal Reserve. Like, they're so desperate to cut right now, and they're just waiting for the Fed. So, just follow what's going on.
It's a good transition because we had a couple big, the UK Central Bank and Bank of England and ECB this week, which I think is the same vibe. I don't think those meetings matter all that much. I think they're just at the whim of what the Fed does, because everyone across the globe wants a cut and ease, including the Fed. But you can't kill your currency and do it. So I think that's probably where the next leg up in liquidity and risk prices comes, in my view, is when the Fed signals. Maybe that comes in July if we get some soft inflation data. Maybe it's later, but I think everyone's just kind of at the whim of when the Fed cuts.
On this point, two things. Check out the DAX and Euro stocks making new highs here. Have you seen that? Like, this is where not only is the S&P, the Q is about to make new highs, but like Euro markets are going up because like they're anticipating a global easing cycle. I think we've probably seen the top in the dollar personally. It's definitely like getting politically maneuvered lower. So, and there's one last chart I think I had in there, Felix, about 2-year yields or real yields in the 10-year.
Here we are.
Yeah. So check this out. This is the U.S. 10-year real yield. So nominal yields minus the rate of inflation is what you get real yields. So that's 210. As that falls, the USD falls with it. It's like very, very good correlated, very, very, really correlated there. So I don't know. I'm partly thinking if you get like the euro strengthening because money will be going back into European markets as they ease. So you have dollars fleeing here and going back into European markets, especially if the DAX and Euro stocks are going up, then, maybe the US dollar takes a leg lower and, the Fed can kind of start easing, or maybe that global liquidity cycle starts kicking in a little bit more.
I think it's possible, but also, I mean, a lot of what's going on right now is that the U.S. economy is just so much stronger than everybody else right now, and you could say a lot of that is attributed to just a higher amount of government spending. And I'll contra myself right now on this because I've been a big believer that government spending is floating up GDP, but I feel like a lot of people aren't considering the fact that as we go into this election phase, we could see this small pocket of maybe you want to call it soft austerity, but like nobody's going to pass a bill from now to the election. I just don't really see that happening. There's a headline coming out the other day that Biden would veto any sort of crypto bill that passes through the House because they're trying to soften some of the policy around that. So I just don't see any sort of policy getting changed from now to the election. And then from the election in November, people don't get sworn in until January. And then, they come in with their 100-day plans. And so I don't know. I feel like nothing would get passed until like mid-February at best. That's a long time from now until then for an economy that's propped up by government spending.
So you think a little air pocket here?
Potentially. And I mean, but on the other side of things is we saw like the Atlanta Fed came out with their projected GDP print, and it's like, I think it was above 4% again. And a lot of the change there was in private investment over government spending, which has actually been trending down. Like government spending has been trending down quarter over quarter recently. So, I'm a big believer in the fiscal dominance narrative, but you can make some arguments against it too.
Yeah. I mean, you see some of the capex numbers out of the FANGs. They're enormous for like AI capex.
It's got to be AI driven, right? There's a massive capex cycle being run in terms of like GPUs right now.
Yeah.
I don't know if you've seen some of especially the posturing and language that's coming out of Mark Zuckerberg at Meta, or some of the numbers that Sam Altman are throwing around. There was an interview that's worth watching from Mark Zuckerberg on the Dwarkesh podcast. It's all about Llama 3, which is this open source model it's extremely good. And it's also really easy to run on like a very small device type deal. But he just casually mentioned that they would be willing to spend no problem $100 billion over the course of the next couple of years on this stuff. And they've already spent billions on GPU. Let me see if I can find a chart of the amount of there was a great like Mag 7 like H100 ownership from NVIDIA. The H100s are the basically state-of-the-art GPUs coming out of NVIDIA. Meta has a ton of them. And I think it was a pretty savvy signal to the rest of the market that basically don't try to compete with us. We're going to outspend you, like, no problem. But there is an extremely like large capex cycle that's going on around.
It's so funny how the Meta stock tanked on that announcement too. Like they had good earnings, but their guidance around the huge capex investment just tanked their stock because, it just goes to show, like, I understand why a lot of these companies want to stay private because you're just playing the EPS expectation beat analyst roadshow, and they don't really care about long-term investments. So when they see, a big, capex spend and build, I don't like that. I want you to be like laying off people and pumping my EPS. So it's shocking to me that crashed on that, because that investment makes a ton of sense to me. Like I'd be more bullish on Meta for that.
Well, you get paid. The other thing is, look, the buybacks. You get punished for capex, and then you get the benefit if you do a massive buyback. And this is therein lies like the financial arbitrage of this whole thing, where I mean, there's going to be 934 billion in buybacks in the market.
I think it's a balance, and honestly, I say this as I can really see both sides of it. It's on the one hand, there definitely is, especially for entrepreneurs that tend to be more empire builders, they're not very concerned with things like creating shareholder value and view that as an obstacle. And I've got this great idea and I should just be able to do this without showing results for a period of time. And there have been a number of radically innovation focused entrepreneurs that have burned through money doing that. On the other hand, there are tons of examples of founders like Larry and Sergey in the early days of Google laying that Atlantic floor cable that like right now, yeah, their stock would get smashed, right? But they had the foresight to do that, and they laid down these extremely structural advantages for Google that no one's been able to overcome, 20 years later or whatever after their IPO. So it's a bit of a mix. I actually don't even think there's probably a healthy balance here between short versus long termism, and really it just comes down to the founder and whether or not they or the CEO or whoever's in charge and whether or not they were right. But that's not even the relevant question. It's just the availability of capital. The availability of capital in private markets is larger than it's ever been. And given the choice, what CEO or founder would subject themselves unnecessarily to scrutiny from public market investors that are more short term? It just doesn't make any sense. I listened to this interview. I really like this guy. I listen to these podcasts, Brad Gerstner, but just talk about how boards need to be brave. And it's like, what are you talking about, dude? Like, you're just telling someone to go directly against their incentives, everyone's incentives. Like, it doesn't make any sense to me. Like, companies are going to continue to stay private for longer. I do wonder if tokens end up being this bridge in between like private and public markets at some interval. But
I think they could, but again, it becomes a political thing. And as we've seen over the last week, like the lines are being drawn right now between the pro crypto Republican Party and the anti crypto Democrats. And it's become really like saw a couple of videos. It seems like Trump had some sort of event the other day in Mar-a-Lago where he basically put out his standpoint in crypto, and it was as positive as it can get. And that happened at the same time that the SEC has been putting out a lot of Wells notices against pretty much any sizable crypto corporation that exists in the US at the same time that they're talking about vetoing any sort of pro crypto bill. So the lines are being drawn right now, and I think a lot of the future potential of something like tokenizing real world assets is going to lie in this election.
Here, to give a little more background on this as well, two things happened this week that were just in stark contrast with each other, and I think is why people are drawing these political lines more strongly than they were before. Trump issued these NFTs a little. He's actually issued multiple tranches, I guess, of NFTs, and in true influencer form, they come along with rights. And there are stories of people taking him giving phone calls to people, but he issued this. I guess I don't know what the exact rules were. You maybe had to own a certain amount of Trump NFTs, but he granted an audience to a bunch of basically all crypto people because you're NFT owners in Mar-a-Lago. And a bunch of people like Selkis went down there, saw Avi Feldman of 1000X podcast went down there. I know Felix, you dropped that in there. And he came out and unambiguously said that he is pro crypto in all ways, shapes, or forms that it manifests itself. That doesn't mean he's a crazy gigabull. I don't even know if he really understands it or cares about it, but I think he is pretty good at seeing where the tide is going, and he sees a bunch of one issue voters probably. On the other side of things, this week, there's something called SAB 121, which was something that the SEC passed, and they circumnavigated some due process to get it passed. But it would require custodians to record customers' digital assets as liabilities on their balance sheets, which basically makes it impossible and extremely prohibitive for these custodians to hold digital assets. And so there was going to be a repeal of SAB 121 because everyone kind of got together and said, this doesn't make any sense. And Biden indicated that he would veto that if it were to go through. So I got to be honest, that one just had even me scratching my head being like, I would love to just be double-sided about this, and maybe there's two sides to every story, but this just seems, I just don't understand the logic on the other side of these arguments anymore. Yeah, I think it's, there are guys like Ryan Selkis for a while, who's the founder at Masari, has been saying that there's not a future for crypto in the US if Democrats take the House for the next 4 years. And I don't believe that, but I do believe at this point it is so partisan and one-sided. It's tough to make the argument that it's anything other than very bullish crypto if a Republican gets in the White House and extremely bearish if the Democrats stay there, which is shitty. It doesn't have to be like that, but it does feel like that's the situation right now.
Well, when your donors are big banks and legacy oligarchs, it's really
but they must be on the Republican side too. There must be some banks on the Republican side and they're pro crypto. So like, what's driving this?
That's really the thing. Is there's some big dark forces, hidden forces behind
or is it just some like political think tank that said if you go against crypto, the left is going to support you? But they a lot of them they hate crypto, but I don't know if they're going to actually be positive if you're going after these through the SEC. I don't even know if they're paying attention, but it seems like that's a calculus. But I don't
forget that the Dems' biggest donor is the biggest fraudster since Bernie Madoff. So they all have such stains on, they're personally and professionally very, very damaged from crypto.
That's a good point.
What do you really think about it, Quinn? It's tough to ever get a real real input from you. Have you guys heard that expression, politics makes for weird bedfellows or odd bedfellows? You can kind of see how this happens. Like, why, if you look at the general philosophy behind even republicanism, why are small taxes and anti-abortion and why are all these unrelated issues lumped together? Just think about how these parties form. It's like, imagine just two guys. Like, one guy really cares about the small taxes thing and also gun rights, and one other guy really cares about the small taxes thing and is also anti-abortion. And they're like, all right, what we really care about is the small taxes. Like, I don't really love the gun stuff. And like, I don't really love the abortion stuff, but I care about the small taxes thing. So fuck it. Let's just all lump it in here and we'll be for all this. That is how these ideas form. And I think that's just what happened. I feel like it's almost random. It could have gone either Republican or Democrat, but this is the way that it's shaken out, unfortunately. The US.
I don't know. I think it's who's buying the most. Did you hear the Tulsi Gabbard thing this past week? She's like, no. We didn't do anything when I was a Democrat of essentially, going to our constituents and figuring out what they care about. It was all about going out, raising money. You'd have a money raising thing at 9, then you'd have a short meeting with someone in DC. It had nothing to do with governing your constituents. And that's largely, this is what happens when you're in a fourth turning and these things get so large, is your incentives change. And you get disconnected. Like, the media is not talking about the things we're talking about, the mainstream media, where we think people care. Maybe we need a bigger audience, but like, I think we're more tapped into what like the next generation actually cares about than these giant huge incentives. And I think that's where they get it wrong on the highest levels.
Crypto's really been struggling over the last couple of weeks for a catalyst, I think, and in some respects, I don't think the market has recognized Trump and Republicans being like undecidedly pro crypto, or undoubtedly pro crypto. So in some ways, that event I think is positive. It's still a little too far out on the calendar for people to be seeing that as a near term positive catalyst. But I think that will at some point come to fruition as we get closer to the election. But I think that's one of the things plaguing crypto right now is just no catalyst, and it generally needs one to go up, just given the supply dynamics.
So here's something that it just has not happened at all this cycle, and there was a lot of debate about this even a couple of months ago when meme coin mania was really taking off. Retail has just not come back to crypto. Period. And we've talked about it on the show before. I mean, we have the back at honestly, we've got multiple different, we've got conferences, we've got a website, we've got multiple different podcasts. We have all of these different metrics to take a look at. Like, we would sort of know if retail was coming back, and they're just not. And you saw it in Coinbase earnings as well. If you look at their, they break out their users on an institutional versus a consumer basis. You can see all the volume is being driven by the institutional segment of their market. And I think that's anecdotally playing out. That's why meme coins are doing well. That's a super crypto PvP game. That's not a new retail for the first time game. Like, retail is not buying BOEM and pumping it to $1 billion in 24 hours. They don't know what that is. It's already dead by the time. So I think that's another big thing that is different. And maybe Felix, you're right. Maybe it is the inflation and people are feeling the pain and they don't have any money to chuck in. I do wonder if maybe it takes the average retail person has some length of time that they need to forget about how much money they lost last cycle. And the shorter than normal recovery between 2022 and 2023 just wasn't enough time for people to fully forget the pain of FTX.
I think that
And
could be a big one for sure. I mean, we've seen a couple bellwethers of that the past week. There's that convocation video, I think it was Ohio State University, where the person speaking started to just say a couple things that were, just like marginally pro Bitcoin, and the whole crowd started booing, and they're like, "Get this guy out of here! This is crazy." And it's a
I
bit of a
love
shock
that.
to me. It's
That
as a
makes me
sentiment
think,
here is awesome.
yeah, that makes you think you're on the right side of the trade if you have any long-term view.
Yeah, but I mean, that really grounded me that that's where the headspace of a lot of the average person is. I don't think they even know that Bitcoin broke all-time highs, and I think they're still thinking this is a scam asset that got marked to zero when the guy with the curly hair went to jail.
you know what else was another instance of that? I don't know. I know we were talking a little bit about this before the show. There was the roast of Tom Brady. They had a bunch of different people out there. They had the athletes, they had the comedians, and this woman, Nikki Glazer, who I think gave probably the best roast of the night, had this jab at Tom Brady, which I think got the biggest laugh, maybe of the entire evening, which was, and you lost 30 million on crypto, Tom, like even Gronk know that not real money, and people just howl, like people.
That was good.
And I saw Kevin Hart's like slapping his knee, like, and Gronk's like, I knew it wasn't real money. And it just tells you where the zeitgeist is on crypto at the current moment,
Yeah. And then, fast forward a year and a half and Kevin Hart will be part of some commercial saying, bet more, basically.
For sure.
That guy will sell it. He still sold anything.
Yeah.
Him and Matt Damon will be on the next one.
Matt Damon's taking some shit for that.
What's interesting is FTX, they're getting back 107 cents on the dollar for, everyone's been paid out on that side. And granted,
Well, at 16K Bitcoin.
Yeah. But that's the funny thing is it's not as bearish as that sentiment would seem, which is probably a good thing.
That's one of those situations where I actually think they did the right thing. Like, for instance, people. So for folks who haven't been following this as much, if you've seen those statistics that they're getting paid out more than 100% of whatever they had in FTX, there was a snapshot after FTX failed. They said, this is the dollar amount of your holdings and you get paid out that dollar amount. The issue is if you were holding Bitcoin or Solana or Ethereum, that's all up anywhere from, 200% to 500% or more from that time. So you don't really feel whole. On the other hand, imagine if they had taken that snapshot and then all of those assets had gone to zero, what do you think John J. Ray thought about those assets? He was like, I need to protect these people from going to zero if that were to be the case, right? So I think it actually was the right procedural thing to do. That's how the procedure should work. But it means you feel burned as hell. You do not feel like you got 100% of your holdings back.
Well, let's also, I think no one really talked about this, but it's important to identify. They mark the liabilities at the Pico low, and they're benefiting from the run in prices. So without that, right? Like, I mean, and that's how you're supposed to run it. You're not supposed to fire sale all these things at the lows, but it was a pretty bleak recovery otherwise. I mean, it was very, very poor until these things and Anthropic, all 10x'd.
So let me ask you guys, do you think this is it's like the question that launched 1,000 podcasts, but do you think this cycle is different from previous cycles? And I have historically resisted that. I don't know. Like, I know, Quinn, you and I have talked about this quite a bit, is actually this cycle is very similar to past cycles. The two things that are messing everyone up is that the Solana ran really hard, really fast. That kind of threw people for a loop. And then also maybe the Bitcoin ETFs pulled forward some of the price appreciation and growth earlier in the cycle than otherwise. And I could paint a pretty compelling picture for either one of those things being true. If I were to do the Steelman for this cycle is the same as it ever was, I would just say that there was there's an idiosyncratic price driver for Solana, which confused everyone because it went out of order. And then I would say that the Bitcoin ETFs pulled forward a lot of the price appreciation because that's happened extremely early in the cycle relative to past cycles. And that this is now we're just taking a breather before the next leg up. The other thing that I could say is like macro actually matters. Like clearly what's moving at least Bitcoin and Bitcoin moves the rest of the market are macro factors these days, like much more so than anything else. And it makes sense now that Bitcoin is starting to trade more along the lines of what drives asset prices globally, which is liquidity and interest rates than anything else. And these 4-year cycles, it never really made much sense why we had the 4-year cycles. And not that this is going to be a super cycle, but we're deviating from the previous pattern. I can make a really strong, you can make a strong case, I think, for both of those. And I'm not 100% sure, at least where I sit on these things. What do you guys think?
I think it is just more tied to macro.
Yeah, I feel like I'm sort of on the same page. One thing I want to say is that I feel like analyzing cycles has caused a lot more pain than gain for the average person. I know like last cycle, a lot of Bitcoin fundamentalists got burned pretty hard because they were looking pretty closely at things like the stock to flow model that was saying that we're going to go to 250K or at the very minimum 100K. And so they got left holding the bag all the way back down again, hoping for that moment. And I'm sure there's going to be some similar ones to this cycle. There's always going to be a narrative that you can spin towards it. And I think hyper analyzing, like sometimes I cringe where you listen to a podcast and the first question they ask is, where are we at in the cycle? Because I think that sets you up down a line of thinking that isn't always the most productive. But maybe that's also just because of how I think of things, which is definitely through like a macro lens first. So for me, a lot of the reason of whether I'm bullish or bearish crypto depends on macro and where we're at in terms of like credit cycles and liquidity cycles. So for me, it follows those more. So maybe there's that portion that's you could argue is a cycle. I mean, I think in the earlier Bitcoin cycles, that was largely due to having dynamics being a lot more powerful than they are now. But I think now it's a lot more just following a liquidity cycle of a broader business cycle.
Yeah, I think I'm falling into that camp also. I do think there are these structural reasons why crypto remains cyclical. I think it's a structurally pro-cyclical industry, basically. And you could like even the airdrop meta that we talked about, but there is the real fundamental reason why I think crypto is cyclical is that in a weird way, block space is this it's like any traditional capex sort of asset. There's a certain amount that you can write to a blockchain at any given time, and the demand around the writing to that block space fluctuates a huge amount, and you actually can't bring enough supply on to satisfy demand when retail starts to come in. And that's why you get the creation of all of these other chains and coins and tokens and things to speculate on. And then the supply schedule of those coins is extremely predatory and leads to people dumping around like when unlocks happen. And that's like really how every single crypto cycle has played out. And that is not changed. That is still the exact same. And I don't really see it changing.
Yeah, I was going to say the best argument you can make for a cycle is the venture capital allocation cycle.
Yes.
Of basically they need those vesting schedules are on a 4-year cycle, and we need to go through that process of gathering the capital, then allocating, then vesting, and you got to pump those numbers up just in time. Sort of idea. That's the cynical take, at least.
I'm extremely biased because my whole strategy is similar to Felix. It's based around macro stuff, but I think I just can't fathom people having understanding of the two, or I think most cases people don't have understanding of the macro and saying it's not. Because if you look at even back to 2018, when we had the sell-off in Q4 from the interest rate scare that impacted crypto, we had a brief liquidity moment in 2019 for all assets, crypto included. That tailed away when we had the back end of the year. We had the repo crisis and other liquidity things, even pre-COVID going into that mess. Bitcoin bottomed in March, and you had all assets printing. Everything that wasn't printed, I should say, went up in price, and helicopter money. And then today you're in a much more, I would say, stop-start liquidity environment, more akin to 2019, and TBD how it plays out through the rest of the year. But in all those instances, I think Bitcoin, particularly in everything stemming from that is very, very explained by the macro.
Well, actually, could I push on that a little, Quinn? Because whenever I think about why the 2018 cycle ended when it did is actually like ICOs collapsing under the weight of themselves, because you had a bunch of people that raised when you raised an ICO, you did your initial coin offering. You didn't collect dollars, you collected Bitcoin and Ethereum. And back then, Bitcoin and Ethereum was, maybe you could do that as a treasury today, but you had real world assets that were, or real world expenses denominated in dollars. So, all of those ICOs that got raised in Bitcoin or ETH, people eventually started to dump those for dollars to actually begin work on the project. And because they were so illiquid, everything just started to cascade down. And it is funny how there are these, if you ask like the VC and builder portion of the market, that's what they would tell you happened in 2018.
Well, the peak in 2017 you're probably right. I mean, we first started seeing cracks in 2018, and like we had the Volmageddon, Jan Feb, and traditional markets. But I think you're generally right. Like 2017 was probably the last, that was when it was actually like kind of hard to on and off ramp funds into the ecosystem still. And so that was probably one of the last eras of where it was less intertwined.
I'll just wrap up with maybe one last thing, but I think you can paint a pretty nice line between those two aspects. And it's because I always think about how shocking it is that a lot of these cycle ideas line up perfectly together. Like you have this debt refinancing cycle, you have the halving cycle, you have the venture capital allocation cycle, you have, at the top, speculation just gets overweight, and then it starts snowballing in the other direction. And I think that makes sense. Like you could say this past cycle we crashed because FTX got obliterated. But the reason those cracks started to show is because the Fed started to turn hawkish, and that basically slowed down credit creation. And once that happened, the snowball started to go in the other direction. And then it's like, oh crap, look at all these issues. So I think you can kind of marry a line between the micro and the macro there for sure.
I like that. That reminds me of the cycles that line up between, like, Neil, you could line up a lot of like Neil Howe's fourth turning cycle over Ray Dalio's deleveraging cycle. There are these things that rhyme with each other, certainly. I actually forget. I had another question for you guys, but I forget. Maybe it's going to be on Tyler's shirt or something. I don't know, Tyler, if you're still dressing up for the guys Emporium hang every week. I like the Hawaiian style that you
got. I'm feeling very Friday. I gotta switch it up from time to time.
Maybe we can end with our meme of the week, which I guess is ourselves this time.
I think Andy is calling us a contraindicator here, or maybe Alf, but yeah, Andy's the best. Touche on this one, Andy. This was good.
Wait, hold on. Huge bullish signal for this is from last week. The market's been grinding up here, not necessarily for Bitcoin, but in general. I think we got that one right.
It's true. We're almost at the highs again.
Yeah. And I just don't see heading into like the summertime. Like if you look at the implied moves per day, it's like under 1% every day for the next like month or two. And then you head into, the summertime where no one's trading, the trading volume's down. So you have $1 trillion of buybacks and credit spreads are tight. Like unless there is some other geopolitical thing that lights a fire, I don't know. I feel like the stock market has a problem. Might not be a great read there. We'll see.
Yeah. I think it depends on where your view is on forward earnings growth. And it was I watched the interview, and it was an awesome interview. Like I respect the hell out of Andy, especially because he owns his when he's wrong, and he's always well founded in his arguments. Like I will back that every day. So I mean,
I think part of it is
the
headline, the titles too, because we're reading on a weekly basis and commenting as things maybe happen more frequently. Shout out Will to the titling.
I also get this, by the way. Like people rip on media companies for this. There'll be like, one headline, which is these headlines that say the opposite thing. It's like, I don't know, bro. We put out a lot of content, try to get both sides of the issue a lot of the time. Like it's hard to make it all line up, and
what's better? You need both sides of the aisle, and
you do
to some degree. You need a little clickbaitiness in it to get people to watch. So,
what I notice, especially with financial media, and like this is, Mike, you could probably speak to this more, but at Real Vision, the more bearish, like you can be, the more eyeballs you would get. So if you had like a really like bearish thesis, you get way more views than if you're like consistently calling accurate things week in and week out. Like that, you slowly build, the right crowd, I think, if you can do that. But the easier one is you get these doomers that like love bear porn. And then you create this audience that's like, the world is ending. And then you can advertise like all your doomsday stuff and like, doomsday prepper type products. But it creates an echo chamber on a lot of media companies when you get that.
Dude, it sucks.
Yeah.
It sucks. There's partly a human bias that you sound more smart when you're criticizing something
Oh, yeah.
than trying to advocate for something new.
I spent most of my 20s doing that. Like, what's funny is like, I was like such a hater for so long. And I'm like, the more and more you learn, you're like, okay, like, let's be a little bit more balanced here. There's nothing more imbalanced than like a guy with high testosterone in his late 20s that like wants to see like the most extreme shit.
I'm 29 and my favorite things to do are snowmobiling and mountain biking, so I'll take that personally.
There you go. I'm just busting you guys' balls.
Yeah.
You guys are very balanced. That's why I like you.
No, I mean, it's true though. And I've been through that phase. Like I went through the rabbit hole of the macro doomer thing. And then I don't know, maybe it's just because I came out and I was so bearish, I'm bullish now. So like I talked about a couple of weeks ago, is like when I came to the conclusion that the longer end of the yield curve is broken, which means the risk-free rate is broken, which means the discount rate that a lot of people base a lot of assets on is broken. Like that just makes me submit to the narrative. And, maybe that's the left bell curve take, but that's where I ended up.
People want to hear that stuff is broken. They just want to hear that stuff is broken right now. It'd be a very unpopular thing to say that. All right, imagine that. So, excuse the like historical reference here, but I listened to this whole episode on podcast series on the Reformation and Martin Luther, and these like diehard arguments that Protestants are having with Catholics. Imagine if you got transported back to that time and you were listening to these people threaten to burn each other at the stake about whether or not the body of Christ was in the bread. And you were like, guys, due respect, I don't really think this matters. Like, trust me, in 100 years, like, you're not really going to give a shit, or you're not going to believe. Both sides would be like, what do you mean it doesn't matter? Blah, blah, blah. And that's like where I think we are right now. Like, I think, I don't know. I'm starting to squint at this and say, maybe we're actually okay. And
I'm going to say something here that's kind of out there, but
yeah,
I thought at first you were talking about Tyler Cowen had a podcast with Peter Thiel recently. They talked some similar parts of this, but it's that political, basically theory. And if you take modernity, there's a problem with modernity where everyone forgot to ask the question what it means to be human. And Thiel basically says the Enlightenment actually was a retrenchment of, the human thought, because you didn't think about religion. You didn't think about these things. And that's when like economics became essentially a religion. I think we're actually hitting this point where economics became such a religion that we forgot to ask ourselves like about like what it means to be human. What do you think about when you're on your deathbed? And all these things people are starting to think about that a little bit more now. You can kind of see the reemergence of religion again. And I think nihilism is going in a bear market. And people will start actually putting their money in places where they believe instead of just like this detached, ETF allocation thing to something that you don't care about. Like people are going to be more cognizant in our generation, I think, of like what you're giving your money to, because it's been completely disconnected with this whole giant institution thing. So I don't know. I guess to your point on, arguing on this stuff, I think that's coming back. I think those like religious things will start coming back because it's been just hidden from human nature for 50 years.
What's a good zeitgeist? What's a good way to get a zeitgeist on things is listening to comedians.
Oh, yeah.
Like whatever makes people laugh, like it's a pretty good way to understand where power resides. And whoever the comedians are making fun of, that's where the powers reside. It's a really good way to get zeitgeist.
Totally.
Comedian stuff is just amazing. Like in my former life, I was working in advertising agencies, and the best things we would do to look at, like most marketing campaigns are anchored to some sort of human insight. And the people that are the best in the world at human insights are comedians, because they find this little nugget and they know how to flip it. And, as advertisers, we would go look at some comedians and see like, what are those little things they say, I never thought about that. Like, they are just so on it for the human psyche.
I mean, Trump is one of the best comedians, I think, in today. Like,
He's not meant to be.
Like,
Dude,
I was gonna say, when
if
we're
you
talking
guys
about his crypto, and he's like, I love crypto, but my favorite is the dollar, the U.S. dollar. So good.
No, wait. Maybe you know what is my favorite Trump clip of all time is when he gets asked about what his favorite Bible verse is. Just Google that. It will have you laughing out loud. He's like, I don't have a favorite. They're all really great. And this guy just prays like, you must have a favorite. He's like, nope. Like, dude,
Love them all.
You gotta listen to it. It's super funny.
Or what about you ever see the stand up with who's the best guy on this stand up? He did
Shane
it.
Gillis.
Yeah.
Shane Gillis,
like,
for sure.
He died like a dog.
Yeah.
When you watch Obama speak about like killing bin Laden versus him getting the ISIS guy.
Yeah.
That one's incredible. He died like
We
a
shot
dog.
him in the head.
Yeah. Beautiful dogs. That's
God.
That's a good thing to watch.
Good way to end.
Yeah.
All right, fellas, we can end it here. Fun one.
Cool.
Take care.
Cheers.
Yeah.